All right, so let's pick it up from where we stopped the last time. We looked at amending statement of financial position. We said that there are some things that will cause the statement of financial position to change, just like how we looked at the statement of profit or loss, that there are some things that will also cause it to change. There are some things that will also cause the statement of financial position to change, and we looked at examples of some of them. Yeah, so the first one was the purchase of a non-current assets. Remember, we said that it will have a knock-on effect because financial transactions are recorded using the double entry system of accounting, where transactions are entered 2 times. And because the transactions are entered 2 times and because of the knock-on effect, the double entry system always ensures that the statement of financial position balances. That is, assets will always be equal to liabilities. Because when there's a change in assets, you want to know how that change came about and what financed the increase in assets or what caused the decrease in assets. If it is the issue of shares that was used to finance the increase in assets, that means that our share equity will go up and our assets will also go up. So there's a balancing effect. So the statement of financial position always balances and assets are always equal to liabilities. And when we say liabilities here, we are not only referring to current and non-current liabilities, but also to equity. So we looked at the purchase of a non-current asset. It has the potential effect of increasing the value of non-current assets and any one of these effects also. Then number 2, if we repay a long-term loan, it reduces the company's liability on the financial statement. Obviously, we are repaying off the loan, our liability will decrease. And then on the other hand, what is the corresponding effect? We have to either issue shares to repay that loan or selling off an asset to repay that loan. Therefore, that knock-on effect that we talk about will always happen. And then also depreciation, but we will not spend much time on depreciation here because it's a whole unit that we'll talk about. We left off um, yeah, yes, and then we also talked about this. I explained this, so you can refer to the last class, and then you'd have a good understanding. Yeah, the case study. Let's look at this case study, which demonstrates how the financial position, the statement of financial position changes when one thing changes. It has a knock-on effect on another thing. So we have a statement of financial position here for a business called BLM Manufacturing Limited. And we can see its assets listed here, starting with the non-current assets, which is this figure. And then these are the current assets, inventory, receivables, and cash. The total of the current assets are given here. So this is the total of the inventory, receivables, and the cash. And then the total assets is an addition of the non-current assets and the total current assets will give us the total assets. And then the liabilities are also listed. When we take all the liabilities from the assets, we have the net assets. And this figure represents the net assets of the business, which is also equal to the total equity. So you can see that the figure for total equity and the figure for net assets are the same. That's what we refer to as a balance sheet, or that's where we say the statement of financial position balances assets and liabilities. All right, so let's look at some changes that occurred here. It says the company's managers needed to incorporate a number of amendments into the figures shown in table 10.5. These are, number 1, the company has taken out an additional loan of 10 million. So let's go and find where loans are on the statement of financial position. A loan is a liability, so we will look at the liability section. Company taking an additional loan of 10 million. So we have the current liabilities here, 4720, and then the non-current liabilities here, 1041. All right. So it's going to change the liabilities of the business. And then the second one change says that some of the company's customers, which into brackets receivables, paid early. This amounted to $100 million. So let's go and look for receivables. This is the receivables figure, and this will increase by $100 million. Remember, these figures are in billions of dollars because we have the $1 million sign here. But let's work with 1,000. So this is 1,075. And then the third one says the company's property has increased in value by 150 million. The company's property has increased in value. So increase in the non-current assets, that will be the property. So 6977 will increase by $150 million. Question 1. It says calculate the revised statement of financial position based on these changes and ensure that it still balances. So these changes will not cause an imbalance. It will always balance because we said transactions are recorded 2 times. So let's look at how it is done. Question 2 says that evaluate the extent to which these changes have strengthened the company's financial position. So let's start with question 1. I have reproduced the statement of financial position here with the original figure. So the original figure is here, and then the various amendments, amendment 1, amendment 2. So the first one, we can see that there is an increase of 10 million here. Where does the increase come from? It says an increase of $10 million in the non-current assets. So let's go back. So that's the first one. The company has taken an additional loan of $10 million and has purchased vehicles. So it purchased vehicles with this loan of $10 million. So our figure for non-current assets will increase because a vehicle is a non-current asset. We are not buying the vehicle for resale, or we are not buying the vehicle. It will not change in the next statement of financial position. It will be used in a business for 5, 10, 15 years. All right, so there will be an increase of $10 million to the figure for non-current assets. What will be the corresponding change? The corresponding change will be an increase in our current liabilities. Increase in our non-current liabilities, sorry. So a loan of 10 million will be repaid over more than a year. So our non-current assets increase by 10 million, and then our non-current liabilities also increase by 10 million. So you can see that it is 1,041 here. It is now 1,051 here, representing or showing the increase of 10. And then this increase of 10 will also be reflected here, but there's another increase of 150, so you can't see it immediately. But if you add 10 to 6977 and then add 150 also to 6977, you get this figure of 7137. So let's find out where the 150 million is coming from. Let's look at the second change. The second change says that the company's property has increased in value by 150 million. So that is the second change. So you can see that here, 150 million. So 6977 plus 10 plus 150 will give us 7137. But this 150 million will have 2 effects. So the first effect is that it increases the non-current assets. The second effect is that it increases the reserves. Now, the company's current assets were valued, perhaps its land, its buildings, and they realize that it has increased in value. That means that if it is sold on the market, if we are looking for buyers to buy the vehicle, buy the building or buy the land, they are prepared to pay 150 million more than its original value. All right, so this is an increase in value, and an increase in value will increase the reserves of the business. It will not increase the share capital because the owners have not put in any new money, but it will increase the reserves, the figure for reserves. And it is on one of our slides. I think, let me find it. It's on one of our slides. Yes, it is on this slide. It says that the figure for reserves rises representing a liability and balancing the rise in the value of assets. Exactly. So when the value of assets increase, the value of our reserves will also increase. All right. So that is why we put the corresponding change in the value increase for assets or non-current assets to the value of the reserves. So 150 million increase here, 150 million increase here. So the figure changes from 2931 to 3081. And then the last change, it says, yeah, that's all. There are only three changes. The second one was some of the company's customers paid 100 million. So if they paid, it will increase our cash. So 100 million will increase our cash, yes, of 100 million, and then it will decrease our receivables, the amount of money we are expecting to receive from our customers who have not paid or who owe us will reduce by 100 million. So 1075 here minus 100 is now 975, and 1,000 cash here, essentially $1 billion, plus an increase of 100 million is now 101,000 uh, um, here. So if we add all of these, we would have a new statement of financial position. All right. Remember that these are non-current assets, 6,977. And then if we add 1,500, 1,075, and 1,000, it will give us this total. But now the total is looking like this because there's a reduction here and there's an increase here. So it balances it off. It stays the same. All right. So our net assets now will be 4,971, and then our total equity has increased. Remember, there was an increase of 150 million here. It's now 4,941. All right. So this is demonstrating how changes occur to the statement of financial position and how these changes have knock-on effects. All right, so the new statement of financial position would look something like this, with this figure for total equity and this figure for net assets. So that answers question one. That answers question one. Question two. Question two says that evaluate the extent to which these changes have strengthened the company's financial position. So let's look at the changes one by one and see whether it has strengthened or perhaps it remains the same. Right. The first change is that the company has taken out an additional loan of 10 million. So to answer, we will say that number one, the changes resulting in the bank loan and the purchase of vehicles will have little impact on the strength of the company's financial position. It will have added to its assets and to its liabilities. Over time, the value of vehicles and the amount of the debt outstanding will decline. So essentially, it doesn't really have any impact on the strength of the business. We have just purchased new vehicles. These new vehicles will not, it's not inventory that we can sell to give profits to the business. These vehicles will be used, of course, by the business, but its value will depreciate over time. Its value will decrease over time. And as time goes on, also, the loan of 10 million that we took to buy these vehicles will also be paid off. So it doesn't necessarily increase the strength of the company's finances. Number two, customers who paid early. Remember, that's the second change. There are some customers who are owing us 100 million and they paid. What effect does that have? Does that strengthen the financial position of the business? Let's look at the suggested answer. It says that the companies who paid early will have had little effect on the company's financial position, as it will have merely turned receivables into cash. Exactly. So receivables is already on our statement of financial position, which is giving us value. The value is 1075. All right. The value is 1075. The value has now increased by 100, but that value decrease of by 100 has now gone into cash. So it's essentially is the same. So if you look at the figure here, the figure for where was it? It caught my eye. Yes, the figure for total current assets is it still stays the same. 3575. It's still 3575 here. We took from here and gave to here. They owed us at 100. It was already on our statement of financial position that they owe us 100. And now they have paid, or they paid early. And that payment has increased our cash, reduced our receivables. It doesn't have any change in our financial strength. It remains the same. And the last one, by far the most significant factor is the rise in the value of the company's property portfolio. It's very significant. We revalued our properties and the value increased by 150 million. All right, so that's the third one. The company's properties increased in value by 150 million. All right, that is the most valuable factor. That is the most significant factor among the three changes. So it says here, by far, the most significant factor is the rise in the value of the company's property portfolio. This increases the value of the business as indicated by its non-current assets and the compensating rise in its reserves, right? So essentially, it is the single factor among the three changes that has caused an increase in the value of the business, 150, which is an increase in the value of the company's non-current assets, is the most significant change here. The most significant change here. I don't know why my pen misbehaves. So 150 here, increasing the value of our reserves from 2931 to 3081, essentially increasing the valuation of the company. The company is now more valuable because of the increase in its non-current assets. I hope these are clear. Any questions on the suggested answers?
No questions, sir.
All right, so that means that we are done with statements of profit or loss. We are done with the statement of financial position, and we can look at our main lesson for today, which is valuation of inventory. So if we look at the statement of financial position here, we can see that inventory has a value here. All right. Let's look at how accountants or how finance people value the inventory. Some non-current assets are easy to find a value. For instance, receivables. People owe us 1,075. That amount will not change. They owe us that amount. It will not change. We cannot call them up tomorrow and say that you people owe us 2,075. They'll wonder what happened. Or unless we have some special terms to the owings that they owe us, maybe we are charging interest on it. But that's a different matter. The value of cash, 1,000 is still 1,000. Well, unless of course there's inflation, but that is another discussion. That's a more advanced discussion, all right? So the value of these items are easy to figure out, but inventory is a bit tricky. So let's look at how we can value inventory. This should be a very short class. Let's look at how we can value inventory. But before that, let's take a trip down memory lane back to AS syllabus, chapter 4. We talked about inventory. I hope you remember. We looked at the various types of inventory. Inventory can be in the form of raw materials that we are using to manufacture our product. I remember that I cited the example of a bakery. A bakery's inventory can be composed of raw materials such as flour, eggs, sugar, that it uses to make the cake. Then its inventory can also be in the form of work in progress. Perhaps it has made some dough, flour dough, from its raw materials that it is keeping in the fridge. So that is also inventory. And then when it finally bakes the bread or the cake and it's sitting in the shelf for sale, it is its finished product. So all these three types of inventories um, represents the inventory for the business. There are also general supplies that a bakery might use: buying paper, buying stationery, buying printer for the buying ink for the printer, etc. These are general supplies that the bakery will have. We also looked at the purpose of inventory in chapter 4. Obviously, is to help in production. If we don't have flour, we cannot produce. So we need to stock up some flour so we can produce. And then just in case something goes wrong, perhaps we have needed some dough and it has been corrupted or it has been poisoned or whatever. Something happened in the fridge or it went bad. Okay, so just in case something goes wrong, we have some stock of flour in our warehouse or in our storeroom that we can fall on. So we looked at just in case inventory management system. Then we also looked at the costs and benefits of holding inventory. It costs money to hold inventory. The storage cost, another cost. It costs money to hold inventory. We looked at that. We looked at some inventory charts where I remember I drew the charts from the beginning so that we can understand how these charts are drawn. And then we also looked at the inventory types of inventory management, just in time inventory management, and then just in case where inventory is held, so that if something goes wrong here, we have inventory to help us in that situation. All right, so that's a quick review of chapter 4. Now, let's look at our main discussion for today. Inventory can also be called stock, or it's more appropriately called inventory today, but it used to be called stock, but it's the same thing. The second point here says that inventory refers to goods held for sale in production or in the process of being manufactured. We know that from here. All right, so that's very clear. And then the third point says that businesses in recent years try to minimize inventory because of storage cost. So we don't need to hold up or hold a lot of flour in our store because it costs money to hold the flour. It can go bad, anything can happen. Our staff can steal our inventory. So it costs a business money. So in recent years, businesses do not hold a lot of inventory because of the cost. And then I put this point also here, it's not in your book, but because of the efficiencies in the supply chain system, it does not necessitate holding lots of inventory or keeping a just in case management system. All right. You don't hold a lot of flour in your storeroom because something can go bad. It is easy to order and to be supplied to you. There is more efficient, there's a lot of efficiencies in the supply chain system. Even if we are in Africa and our suppliers are in China, because of the efficiencies in the supply chain system, they are able to ship to us what we need within a very short time. And therefore, it does not necessitate holding large stocks of inventory. All right, then the final point here in purple here means that it's an important point. It says that inventory valuation is important because it helps determines the value of a business's assets and the value of the business as a whole. Yes. So if you go back to assessment of financial position, the value of the business that we have here, 4941, is also as a result of the value of its inventories. Out of a total of 4 billion, which is the value of the net assets or the value of the business, inventory represents quite a number, which is 1,500, 1.5 billion. All right. So if we don't value inventories properly, we are not valuing the business properly. So inventory valuation is very important. However, it is difficult to value inventory. Why? Why is it difficult to value inventory? For instance, in the example that I cited, flour, the flour can go bad. The flour can go bad, and that means that it will lose its value. All right. I sometimes cite the example of my sister who works as a food scientist in a flour manufacturing company. And sometimes she tells me she's a quality control officer. She tells me, I I rejected some grains, I rejected some flour, and my management is not happy with me because it costs money for the business to buy a new grain. And I'm like, go ahead and do your work. Because if the flour is insect infested, it's losing value. It's not as wholesome. Its value is bad. That means that you're going to get bad bread if you use that flour. All right. So some inventory can lose value. So it is difficult to value inventory for some of these reasons. One, It can lose value because the item is perishable. So it says that food items or ingredients, for example, lose their value as they begin to expire. This makes the valuation of inventory more complex as inventory of different ages have different values. That is a very straightforward point, that the value of some inventory will be lost because it's going bad, it's perishable. Number two, inventory may be a fashion product and therefore have less or more value. And here it's either losing value or gaining value because of taste in fashion. The taste and preferences of people, consumers change over time. So if you are a retailer, a clothing retailer, and you have huge stocks of a particular design of clothing, and as time goes on, you still have these clothing in your inventory, and people are not buying. As time goes on, as the years go by, nobody's going to buy because the trend has changed. The fashion taste and the sense of people have changed. So this makes your inventory difficult to value. You have clothing in stock, they are not bad, as in the material is good, the fabric is okay, it's in a good condition. But what's the value? How do you value it? What value do we assign to it? It used to be $28 per piece. Can we still sell it for $28? You might have to reduce the value. Sometimes old fashion also becomes trendier, and therefore even your old stock will be more valuable than it is now. All right, so these are some of the difficulties in valuing inventory. What is the solution to this? We'll find out. But the third one here says that when valuing certain inventories, it can be difficult to define a market price. For example, a business selling antique furniture or works of art. It might be a piece of trash to me, but it could be worth millions of dollars to someone else. All right, so works of art, antique furniture, etc., is quite tricky to value. What value do we assign? It depends on who is buying. Like I said, it may be worthless to me, but it is worth millions to someone else. So how does the business value it? Does it maintain a high value for it, or does it maintain a low value for it? Depend on who is buying, you wouldn't know how to value it. So it can be tricky to value some of these things. And then the last difficulty here is that valuation can be affected by a range of external factors. Example, global oil prices, gold prices, oil prices, they change frequently. All right. And there's a good example here. In 2020, in the first month of 2020 alone, global oil prices varied between $63.27 per barrel and $11.57 per barrel. Look at the change in 6 months. So we have stocks of oil, barrels of oil. What value do we assign this on our statement of financial position? What is the value we use on our balance sheet? Within a period of 6 months, it has changed value. All right. So it can be difficult when you are dealing with some of these things. So let's look at one way. There are several ways of valuing inventory, but we'll look at just one way, which is called the NRV method of valuing inventory, or the net realizable value. Very simple technique that makes some of these problems disappear, or some of these difficulties disappear. All right, so this net realizable value method values inventories at their likely selling price. So just value it at its selling price. If you take it to market today, if you take that piece of clothing to market today, if you take the gold to the market today, if you take the oil to market today, you bought it at $68 per barrel. It is now $11. What should be the value? You still want to maintain $68? No, you cannot. Value it at its selling price, how much it will cost on the market today. That's what the net realizable value says. But you have to subtract the costs associated with selling it. You have to subtract the costs associated with selling it. So it says value inventories at their likely selling price minus the cost associated with their eventual sale or the cost of disposal of the assets. All right. So we have some inventory It is oil. Oil. We want to sell it. As we are selling oil. Our price do we sell it? Sell it at the market price, the selling price, minus if there are any costs that we will incur, the cost of transporting it, the cost of advertising the asset for sale, etc. And then you assign that value to the assets, to the inventory on your balance, on your statement of financial position. The second point here says that it is commonly used. It's the most common used method of valuing inventory so as to ensure that they are not overvalued or undervalued, right? So value essentially here, as defined by the net realizable value, is what the market will pay for it. That's what is the selling price for it. If you take it to market, how much money will buyers offer you, all right? Or if it is a global commodity like oil or gold or any of these commodities, then you use the selling price, the market price, minus the cost of disposal of that assets. All right. So here we avoid overvaluing or undervaluing our inventory on the balance sheet. And then the last point, very important point, talks about IFRS, that the accounting rules as provided by the International Financial Accounting Standard, IFRS, requires businesses to value inventory using this method, using the net realizable value method. So IFRS rules require that accountants or businesses value their inventories using this method or this technique, meaning value inventories at their costs or the net realizable value, whichever is lower. So usually the terminology is value inventory at lower of cost or net realizable value. Value inventory at lower of cost or their net realizable value. What does that mean? If the cost at which we bought the inventory is lower than its net realizable value, use the cost. If the net realizable value is lower, use net realizable value. I'll say it again. We are valuing inventory at their cost, or we are valuing inventory at the lower of cost or net realizable value, which means value the inventory on your balance sheet, on your statement of financial position at the cost at which you bought them, very unlikely though, or at their market value or at their net realizable value, which is their selling price minus the cost of their disposal. All right, let's look at the steps in calculating net realizable value. Number one, calculate the total value of all inventories held by the business. Very simple. Calculate the total value of all inventories held by the business. Value here means that the amount the company could sell its assets for on the open market. So that I said the market price. Okay, so if you take your asset to market, how much on the open market, how much is it valued for? So value that. Number two, the cost incurred in selling each inventory possesses must be deducted. The cost incurred in selling each inventory. I don't know what this word is doing here. I'll look it up. So, but let's proceed. The cost incurred in selling each inventory must be deducted. Let's get rid of this word. I don't know why it is doing here. The cost incurred in selling each inventory must be deducted. So what cost are we referring to? Cost of advertising the inventory for sale, distribution costs, etc. All these costs must be deducted from the open market value. And then number three, deducting the cost associated with selling the products from the value calculated in step one. All right, so we have found the value in step one. We also know the costs that we will be incurred in disposing the assets of. We deduct this number two from number one, and then the third value will be the value of our inventory. So let's look at an example. Let's look at an example, and then we'll bring our class to a close. We will not spend much time today. A business manufactures cans and bottles for use in the food industry. That's their core business. They manufacture bottles and cans for use in the food industry. On the day its statement of financial position is drawn up, it has the following inventories. It has 2 million cans as inventory that can be sold for 30 cents per can, 500,000 small bottles, each with a selling price of 40 cents, and then 600,000 large bottles, which can be sold for 60 cents per bottle. So let's go through the steps. Step one says that the value of the inventory must be calculated. So the 2 million cans, which is sold for 30 cents, plus the 500,000 small bottles, which can be sold for 40 cents, plus the 600,000 large bottles, which can be sold for 60 cents. All will give us 1,160,000. Very simple calculation, isn't it? And then step two, it says, let's assume that the cost of advertising and distributing the cans. So it's an assumption because we are not actually going to sell it. We just want to value our inventory on our balance sheet. So assuming we are going to sell it, what cost are we going to incur? It's going to cost us $85,000 in advertising and distribution expenses or distribution costs to sell this $1,060,000, $1,160,000 worth of inventory. Therefore, using the net realizable value method, the value of our inventory is this. 1 million, which we calculated, 1,160,000, which was calculated, minus the $85,000 distribution and advertising expenses, which is $85,000. Minus that will give us $1,075,000. Very simple. That is the net realizable value method of calculating inventory. Any questions? Is it difficult?
No questions. It's not really difficult, but it's not easy either. So,
Oh, okay. All right. It's actually easy. I disagree with you. It's actually easy. So let me go through the steps again. Number one, calculate the value of all the inventories held. Then estimate the value of the cost that will be incurred in selling it. And then you subtract the two, and then you have the value for your inventory. All right, so let's end our class with this case study. You have two more slides to go. So Gotch Mineral Company. Gotch Mineral Company is a mining company which operates a number of mines in South America. Its mines include the Crib Gold Mine in Honduras, the Sao Cisco and Sao Porto gold mines in Brazil, and a copper mine in Mexico, and recently opened copper and iron mines in Brazil. Its products are used by a wide range of manufacturing businesses. The company announced its trading figures for the third quarter of 2020, stating that its revenue fell by 9% compared with the same trading period during 2019. The company mined 50,101 ounces, which is 1,420 kilograms of gold during the first half of 2020. The price per ounce, which is 28 grams, realized by the company for gold rose from 1,529 to 1,730 over the same period. The company valued its inventory using the net realizable value method. Question one, analyze one reason why inventory valuation is a particularly important issue for manufacturing businesses. And then question two, evaluate why the use of the net realizable value method of inventory valuation might be a good choice for Gotch Mineral Company. Okay, so let's go through the suggested answer. So manufacturing businesses usually hold substantial amounts of inventory in the form of materials and unsold finished items, assuming that they do not use a just-in-time inventory control system. This is likely to represent a significant holding if the business is to avoid delays in production. Now let's answer the question. Because of the potential scale of inventories, accurate valuation is important if the business is to calculate the cost of sales correctly and thus to be able to calculate an accurate profit figure. So an accurate valuation of our inventory helps us to calculate our profits. And I'll explain that later. Uh, and also, an accurate valuation of inventory also helps us to accurately value the business. All right. So that is the first um, answer. That's the first suggested answer, the first way we could answer that question. And then the second question says that evaluate why the use of net realizable value method of inventory valuation might be a good choice for Gulch Mineral Company. Obviously, we could say that it is the accepted way of valuing inventory, and IFRS even recommends it. So let's look at how to answer that question. Number one, it says the net realizable value method of inventory valuation is a safe choice for the business's managers, as it is the recognized method used by many businesses across the globe. This approach to valuing inventory meets the rules of the International Financial Reporting Standards, IFRS. And then we could also say that its use will help engender confidence among the business stakeholders, as it will avoid the dangers of either undervaluing or overvaluing the business's inventory and will provide a more accurate figure for profit. This is particularly important for this company at a time in which the price of gold is rising sharply. All right, so remember the difficulties we said where we have when we are valuing inventory because sometimes the market prices for some of these commodities change. So in order to avoid any problems, any issues with the stakeholders of the business who may have an interest in the value of the business and the value of the company's profits, we avoid the issue of either overvaluing or undervaluing when we use this method, the net realizable method of valuing inventory. However, the question here says evaluate. So these common words that we are to pay attention to when we are answering questions plays out here. So because we are evaluating, let's look at one negative. It says that, however, the business should use only, however, the manager should only use net realizable value method unless the cost of buying the inventories is lower. However, the manager should only use NRV method unless the cost of buying the inventories is lower. But this is unlikely to be the case with Gulch Minerals because gold manufacturing business and the value of gold on the market is usually increasing. All right. So see you next time.